The VIX is the implied volatility of the options on the S&P 500. All right, and if you extract this one derivative of the S&P 500's options, it can be taken to mean a very stochastic reading of fear levels in the market. Really high VIXs equals people willing to pay a whole lot more for insurance in the marketplace. Options can be treated as ways to put insurance against large portfolios in the S&P 500 without actually having to actually liquidate huge amounts of money. When you have like billions of dollars of money inside something, it can be very hard to find an exit really quickly. So most of your massive funds don't sit there and kind of like sell out, $200-300 billion worth of S&P 500 in a panic. Instead, they hedge the downside risk by buying options to protect from the market crashing in your face. So if you go buy a fucking shitload of puts right now, let's say the market's not done anything, but you have some inside intel that tells you, hey, this thing could come down in my fucking face. I have $100 billion worth of S&P 500. There's not enough liquidity to hit the fucking sell button and get out right now. I'm going to get demolished if this thing comes down. Fuck it. I'm going to go buy some put options against the S&P 500 in the event this happens, and I'll buy enough deltas to make sure my portfolio doesn't fucking get annihilated. If you do that and you increase the demand for those put options with nothing else happening, right? Demand is going to drive up prices. That's what the implied volatility basically captures. The fact that a person is willing to pay more for those puts than they were yesterday. So a rising implied volatility, or VIX, is telling you that someone is basically demanding options and increasing the cost of them. So they're basically telling you that they're willing to pay more for the insurance to protect themselves. So it's a measure of like, how much fear do you have that there's downside possibilities in the marketplace? So that's what the VIX tells you. When you look at the VIX and it crosses 21, that's pretty much a threshold where there's enough of that action to tell you that people are generally getting the fuck out of the way of a train. And you don't generally want to fucking try to figure that out. Like you can spike 21.5 and come back down. You could blow through 30. Above 21 as this historic norm I've established, and most people say 20, but I say 21. The market I overlaid onto this so you can see it, right? 21 is this blue line. And north of 21, if you look, right, the market literally gets leveled. And you don't know how far the VIX is going to blow through 21. Just above here, it's Armageddon type shit. The market can do just fine, like from 21 down and basically stay in an uptrend just fine south of 21. But you notice when you blow through 21, literally holy fucking hell happens to the marketplace. So just as a historic norm, it's within the stochastic measure, I established that 21 is pretty much the line in the sand where risk assets get blown apart. There's enough hedging and enough people unwinding fucking risk assets that this is just a bad place to be. And so people continue to buy insurance to protect themselves as the market de-risks. The fact that, risk assets are correlated means that when you look at like real estate's got like a 95% correlation to S&P long-term. There's a lot of margin activity that comes from the S&P to buy real estate. People borrow margin capital off of stock assets and buy cash flow assets in residential real estate. So when the market de-risks, you de-risk the lines of credit that buy real estate. They'll pull real estate with it. So it creates an interlink, which creates a high correlation. And then, of course, if you have lots of margin credit coming off of stocks, it's not just going into real estate. It's going to go into things like crypto. And it's going to interlink crypto also. So you're going to create a massive interlink of risk assets, which basically the VIX can track the explosion of all of it. So that's one reason we follow the VIX, because he's tied to the biggest risk asset pool in the world, which is the S&P 500. And pretty much everything, is built upon leverage in the system. So everything is interconnected with the This was supposed to be a show about energy. I guess you can just bookmark it to go back for a show about the VIX, but it was supposed to be a fucking energy.